Good morning, everybody. Welcome into this long-form episode here of Mining Stock Daily. Standing here at the port of Vancouver, British Columbia, along the harbor, just watching all the ships roll through, all those commodities, goods, resources that move through this port each and every day. Absolutely beautiful out here, and it's fitting because this week we got a special conversation with one and only Paulo Macro. Don't be fooled just because he's got Macro in his Twitter handle. This guy cut his teeth trading commodities, and we're going to talk about why he likes to trade as close to the actual commodity as he can, and not necessarily the equity. So it's a really interesting conversation with Paulo Macro, and we go into depth for about an hour of kind of what his positioning is and how he finds trades within the entire commodities complex, including the metals and miners. So we talk some copper, some uranium as well. Great conversation. Special thank you, as always, Arizona Sonoran Copper, Fireweed Metals, Victoria Gold, and Visa Silver for the continued support of Mining Stock Daily. And if you wouldn't mind, hit that like, subscribe, share on the podcast, on the YouTube channel, all those things. All right. I'm up to the Yukon this week, everybody, so it's going to be sporadic on the podcast, but enjoy your weekend and especially enjoy this conversation with Paulo Macro. Be well. Welcome into Mining Stock Daily, everybody. As you can see, I'm going a little bit casual today. A lot of preparation, actually. We'll be leaving the studio tomorrow and heading north and visiting colleagues and friends and sites in British Columbia and also in the Yukon over the next week. And so I'm just running around trying to do the pod, then also getting ready to leave for an extended period of time. But we're going to finish this week with a great conversation here. Somebody I had the opportunity to meet in person, although he does like to remain anonymous online. He goes by Paulo Macro. He's a great voice. He's got a great Substack out as well that I'm also a subscriber to that covers a lot of just kind of what he's thinking as far as markets and trading opportunities. And if you do get a chance to read it, you'll notice there's a lot in the entire commodities space in there, not just metals and miners, but we're going to talk energy and agriculture as well. So without further ado, Paulo, welcome into the pod. Nice to see you.
Thanks, Trevor. Really happy to be here and think really highly about your laser focus on the mining space in particular and the work that you've been doing, and just delighted to be on the show.
I appreciate those kind words. I think for, just because this is the first time you're on the pod, let's get a little bit of a background. I mean, you've got an extensive career in markets and trading and investing, and talk about like where you kind of started cutting your teeth in your career.
Sure. I'm a bit of a misfit toy in the finance industry, but the shorter version is I graduated college in the early 2000s, actually not with a degree or anything relevant to finance, but actually a BA in music. And for really just a desire to make a little money, started summering on the sell side in the strategy group here in New York, where I still live. I'm born and raised here of Brazilian parents, and so kind of grew up with a foot in both worlds. A New Yorker who's a rare breed that's actually from New York, but also with Brazilian background. I speak the language and have traveled to Brazil and the region pretty extensively over my career, both for to see family, but also for work. And with 9/11 and then coming out of college, decided to take a brief year off. And as I mentioned to you recently over drinks, I spent a year with my college roommate living in Vail, in West Vail, back in the 02-03 season. Came back to New York after the fun was done. And I always like to say, the winters are terrific, but the summers are what make you stay for life. And I left in April because if I had left in July or August, I wouldn't have left. I would have stayed forever. So, and my wife knows that if we ever live anywhere outside of New York, it would be in Colorado. So we have that connection. Now I'm just a tourist when I do get out there, but came back to New York and actually started my career on the buy side, working for a series of long-only mutual funds focused on international small mid-cap. This was in '03, and started off doing the job that nobody wanted to do on the desk. So I always joke to people who are starting out, try to do the job that your boss doesn't want to do or that nobody's done in 5 or 10 years, and you'll be in pretty hot demand within a year or two. Everybody will need your expertise because that's just the nature of cycles. And my corner of the world in international small cap was Australia and New Zealand, and sort of overlaid that with metals and mining and oil and gas equities. And that was right on the brink of China's big coming out party. And by 2005 had moved to the other side of the phone call, ended up on an Australia sales desk here in New York for a major bulge bracket. And that quickly morphed into kind of a broader cross asset role, but with a focus always on equities and commodities. So if, a large hedge fund wanted to be long BHP, short copper futures against it, that sort of trade came to me. It felt like easy work at the time because, the sun was shining and everything was just going up relentlessly. And there was so much action. You had a lot of M&A, especially in the mining space around mid caps, Phelps Dodge getting taken out by Freeport, Vale buying Inco. And, it's amazing to watch how the pressure builds on, kind of bigger tier mining executives to add to mine life after they've been out of favor for a decade plus. And, you start to see the style drift equivalent in industry where, an iron ore force like Vale wants to get into nickel of all things. You need to start, the clock starts ticking and it, but this is still 2006 and it's party on Wayne, party on Garth. By early 2008 or late '07, started to, get hip to what was going on in the credit space. It wasn't a point of focus for me. I more kind of tripped over it by accident based on where I was working at the time. And having sort of seen a down cycle or the tip of a down cycle in '01, '02, around the time I was coming out of college, it felt to me like this was the start of potentially like a real serious rupture in finance. So I left where I was working at. Lehman happened and then the world ended. I ended up sort of lost for a little while and retooled, thinking originally that I would go back to the buy side to some sort of hedge fund analyst role with a PM track. And with so many resumes on the street post Lehman and me coming from a sales role, that was an almost impossible transition to make. So I ended up as a salesman for hedge funds, and I went from pitching ideas to hedge funds to pitching hedge funds to allocators like the family offices, foundations, endowments, fund of funds, pensions, et cetera. And did that for a couple of years. And that was sort of like going to college if you want to really look over the shoulder of hedge fund players, because it's one thing to talk to them on the phone as a counterparty or a broker. It's another to actually be in the room with them, watching and listening how they put their portfolios together and manage risk. But the speed and the action just wasn't there for me. And it felt like you're really in the back seat or just a mouthpiece. And by 2012, I sort of decided to start over. So it was time for chapter 3. That was kind of chapter 2. Mm-hmm. And after a year sort of on the beach and retooling and thinking about where the industry was going, and the industry was actually in really rough shape still. It had recovered for the people who had staying power, but there was a hollowing out of guys in my age group. And you'll notice if you look around, there's kind of an age gap on Wall Street of people in their 40s, precisely because a lot of people got the axe. We'll call it 40s, early 50s, because a lot of people got the axe in '08 and never really found their way back. They kind of drifted to regional brokers or $2 shops and your payouts and things like that. And they, gradually with the constriction of the industry and the consolidation on the sell side, followed by the consolidation in response on the buy side, a lot of people have just been kind of let go and never really made it back. So in 2013, it was time to start over. And I figured what better way than to take my past experience in doing a variety of things focused on equities and commodities, and then bringing that in with my language and passport on Brazil and focusing on Latin America. I figured LATAM had been in the bear market by then, at least multiple wise for a couple of years. I think the top was in 2011 was the real kind of double top on '08 for Brazil. and it took another 3 years to find a bottom. But in the process, sort of rebuilding my career and creating, just a client base and hopefully a reputation of being a sharp guy with, the global perspective on a regional local market, and spent the last 10 years doing that. Late last year, I ended up going out on my own, deciding to take a break, and Substack was sort of the outlet for me in continuing to. I've had some, personal successes away from my work over the last couple of years on the investment front, and thankfully a bit of runway. So right now is really just a window in time for me to enjoy my children. I have 4 young kids, and in the meantime, kind of look after my own money. But also, writing has always helped me think and helped me operate better in the market. Writing makes it real. I've always sort of kept a trading journal or a diary, which I will never show anyone because it's so embarrassing when you look back at the mountain of mistakes and the stupidity you did in your 20s and 30s. And I'm sure when I'm in my 60s, I'll think, man, in my 40s, I was really off tilt. So now I do the Substack. I have a great following there, and it actually really started on Twitter a few years ago during COVID for just lack of not so much boredom, but like isolation. Twitter was an outlet where a lot of people found each other just to be in contact on what was going on in the market. And a lot of people came from that to Substack. Earlier this year, I launched it in January, and it's been going great. I love having more of a dialogue with people directly, and Twitter can get a little exhausting. It's kind of a dopamine hit one after the other, and then people can really take things the wrong way or rub each other the wrong way. And there's a lower level of signal to the noise in a marketplace that big versus having, just even with like a modicum of like a subscription base kind of keeps a lot of the noise out, and everybody sort of wants to be there. And I have a lot of respectful disagreements and exchanges with people who have actually really added value to my thinking and hopefully make me better for them. So it sort of feels like a win-win all around. And I'm just grateful to have, my subscriber base and the people who are there to support me and there to help me think more clearly and hopefully help them. So that's, as I say, I am a misfit toy in the industry with a lot of different skills in the rear view or experiences in my bag, I mean. But don't know what sort of the longevity of all this is. I figure I take a year or two as a transition to really enjoy my family at an opportune time while they're still all kids and see what 25 and 26 hold. And maybe that's just to continue to do what I'm doing. But that's sort of the longer version. Sorry.
No. Don't apologize because it all comes to, it all is referenced back to where this conversation is going to go. Speaking of Twitter, like I have noticed in the last couple of weeks, like the algorithm that's presented to me is all over the place. There seems to be a lot of like new content I'm getting just randomly, and it doesn't quite make much sense. But I will say what never fails is you can kind of, if you have that barometer in the commodity cycle, Twitter's a great place to know when perhaps the short-term top is in. We saw it in copper a couple of weeks ago when it was above $5 a pound, and every copper bull was patting their own back on Twitter. We saw it in uranium last year as well. I mean, when uranium spot price was whatever it was, $120 a pound, get a lot of congratulatory people congratulating themselves for that, and that's usually a great barometer of when the top is in, right? So it's
actually,
like
I totally hear that. I didn't mean to interrupt, but I was just thinking to myself this morning. I was exchanging with a good friend of mine before uranium put in a real proper top. I think it was sometime in December, where I told him, man, I'm not normally a gentleman's bet kind of guy, but let's just say I feel really strongly that in 6 months, call it June 30th, copper will have done better than uranium. And it felt so stupid and crazy to say that at the time. But when you see how polar opposite the sentiment and setup and positioning was in both, for a while there, it made a lot of sense that uranium would come off the boil and have to chop some wood, and that copper, might go on a little bit of a run. I did not expect copper to blow to $5, but this is sort of also the nature of where bull markets go next on a long-term sort of structural view. That I personally think that, and granted, I didn't get out of as much as I wanted to above $5 in copper or above 30 in silver. It's the curse of leaving money on the table, but I'm not playing for $5 in copper either. So, my expressions will kind of change at the margin where I raise a little bit to do something somewhere else, but I don't really move my book around massively on the stuff that I'm looking to hold for a few years. Mm-hmm. Uranium was a little different for me because I had a trade on last year that was just a home run where Diablo Canyon dropped that RFP in May. I think it was actually in March, but in May we heard that it was getting done at 59 and spot was sort of in the high 40s, low 50s, and immediately it just tacked on $5 or $6 at the whiff of this RFP clearing above the market. And my friend Cuppy, Harris Kupperman, who runs Praetorian, he's had this view for a while on the reflexivity that he likened back to Bitcoin and the Grayscale Trust a few years ago, where he crushed a trade that as long as this is trading at a premium to NAV, they can raise money to buy the underlying, tighten the float of the underlying, in this case, physical pounds, through sequestering, and retail will then wake up to a rising spot price, and around we go, and the two reflex on each other. My trade then last June, I noticed that the U.S. ETFs, URA and URNM, which had just been picked up by Sprott as the sponsor on the mining trust, URNM, not trust, the ETF. And I noticed that 10 to 15% of both of these ETFs were Sprott, the underlying trust. And it occurred to me with options trading on these two instruments that you could buy wingy, low delta, out of the money calls. And things were so illiquid last summer that this is a bit of a story. I hope you don't mind it. But the way I wanted to express it then was guys will gravitate to try to find torque where they can because the Sprott Trust is a little bit hairy, especially for U.S. retail. There's no ADR. The SEC won't allow it. So why go through the trouble of buying a PFIC? It's not that big of a deal, but you still have to file the 8621 at the end of the year with the IRS. There's a bit of a headache, right? But it's so much easier just to buy the miners ETF because we all know miners are beta to the underlying price. So if guys start to wake up to the uranium price moving by buying URNM, and suddenly I noticed that whoever was selling me these out of the money calls, it was illiquid enough that they were having trouble doing it in the screen during the day. And suddenly that stopped. And the trade worked awesomely for the summer and into the fall. And then for a variety of reasons sort of stalled out. But I remember thinking to myself, by the time like this thing got very visible towards the end of the year and people were really hot for the miners in particular, and these things were baked in for $90 plus a pound, that you're probably getting close to a point where we have to frustrate and rinse the position, even if it just involves chopping wood and going sideways. So it's a very long way of saying there are ways to sort of structure trades and think about how to torque something. It's not easy. And I generally prefer to stay as close to the physical as possible. I don't stray often into the producers or the more speculative mining, exploration, production, or oil and gas exploration, production set. Mm-hmm. But there's always stuff like this to do on a 6 to kind of 24 month time frame. For me in copper, especially since you brought it up, once we got through that $5 and flushed a marginal new all-time high, it's very easy in retrospect to say, oh, the position was wildly extended. It was, although historically, if you look at points over the last 20 years when the copper positioning gets extended to the point where it's at new highs in terms of length in the market from specs, that's a point where the copper price generally, even if it corrects, keeps on going. It takes about a good year before the actual underlying copper price tops. So this back off from a marginal new high, to me, feels very healthy from the perspective of guys are worrying about recession. What does this mean about China? The Chinese real estate talk on Twitter is getting very loud again. It even concerns me to a certain point, to see that the Chinese real estate market might have, Japanification written all over it and 20 years of deleveraging, blah, blah, blah. I don't think that necessarily is going to remain the primary driver of copper demand going forward at the margin. but it's certainly the thing that people focus on because it's the largest piece of the copper demand pie. But these sorts of flushes and corrections and back-offs of new highs are actually what it takes to set up the bull market for the next round. It's just a matter of either flushing the price hard or chopping wood in time, or a combination of both. It's always price and time. And then at some point we get to a point where it feels a little less visible and it starts to work again. Ironically, uranium felt like we got there a few days ago, last week, where the discount for the Sprott Trust got down to double digits, like north of 10%, maybe 12%. On a spot price in the sort of low 80s. So what it was telling you was that Sprott was discounting 75 or thereabouts at the trust level, right? Between the discount to the spot price and of the physical. And with term at $77 to $80, like, that there's a floor somewhere in here. At some point it becomes, cheap enough, or, the spot price gets close enough to term where even a Cameco or anyone who's over contracted in the near to midterm will show up in the spot market and top up pounds. So knowing that the floor is there and that people are frustrated, these kind of opportunities come and go. But I think about all of this in the context of a bigger rotational market among commodities. It's very different for me than the 2000s where China lifted all boats. There's always something to do.
Paulo, let's talk about let's talk about that. About where we're at in this cycle and kind of your thesis. Before I get there, I want to lay that there, but I got to ask you because I want to go back. You mentioned PFIC, and this is really particularly pertains to U.S. speculators and investors. This is something that's come on my radar. I mean, a lot of these companies that are Canadian listed companies are registered under a PFIC in the U.S. Is this something the retail speculators need to be very, very mindful about?
I would be aware of it. I've owned even Canadian mining juniors that turned out to be PFICs that I didn't know about, and there are obvious ways to, you can always claim like, hey, none of this is tax advice, mind you. Like if you find out that you own a PFIC, you should look into at least kind of running it by your accountant and letting them know, because you probably need the 8621 filed. There are a couple of random, it's a weird structure where the Canadians don't want to get into any kind of trouble, even if they're just drilling holes in the ground.
Right.
So they default to saying that they are a passive foreign investment company. And I own a few of them, and they tend to release a form at some point in the first half of the year, which is why now I just default to getting a tax extension, because some of this stuff, comes out after April 15th. It's not the end of the world if you haven't done it, but it's one of those things like, the feds get very angry if they find out that you're invested abroad and didn't disclose it, right? And I don't think that they had junior mining stocks in mind, because your broker that you hold the account in is going to, like, the IRS is still going to get their money when you sell the stock, because the broker is going to tell them that you sold stock. But it's just a wrinkle where the Canadian managements, I think, are looking to protect themselves from potentially being seen as some sort of passive company. I'm not an expert on any of this, so please, like, get your own tax advice.
Either am I. That's why I'm asking, because this has just gotten on my radar the last probably month or two, Paolo.
Yeah,
so I'm trying to wade these waters too, and try to figure out what's applicable.
It's come from the Canadian side, where these managements just don't want to find out that they stubbed their toe and owe some kind of disclosure fine because of X, Y, and Z. So a lot of them, as long as they're not paying a dividend and they're just spending SG&A and putting holes in the ground, they tend to just classify themselves as PFICs for U.S. holders. And frankly, it's not fully clear to me why so many of them elect to do this. But it's a bookkeeping that, basically I would assume that if you're buying a Canadian junior, you're probably buying a PFIC and you want to browse around the website, because usually there's a spot where they disclose it and they have a form, and you just, you file the 8621 and that's it. It's a simple disclosure that you own shares in a foreign investment company. And
Yeah. Okay.
And then you move
we're
on.
not going to get down the weeds into tax law here, but it is something I think people need to be mindful about because it's been on my radar. But let's get back to where we are in this cycle. And I've posed a question here a couple of times in the last couple of years about a commodity cycle and the necessity for it to be with foundation from Chinese procurement, much like we had in the mid 2000s leading into 2010s. And my argument is I don't know, and I'm not convinced that China has the buying power after all that spending spree and stimulus from back then, Paolo, but it could continue to happen on the backs of Western stimulus, infrastructure spend, and now even, to be honest with you, digital infrastructure spend with tech companies needing to build out their own data centers with the power of AI and just the digitization of everything in our economy right now and in society. And so I guess if you look at the cycle, the commodity cycle, is a super cycle, likely or possible in your eyes? Where are we in the cycle? And I guess, what is it, a collective movement rather than just based on one, growing and spending country such as China?
Yeah, I tend to think that there's a moment. The demand statement for commodities is becoming more diffuse. And I think that there is a story that catches fire over the next 5 to 10 years that is precipitated by supply underinvestment over the last decade or so across commodities, especially metals and mining, but also oil and gas. And that at the same time, it's all connected in the sense that China still has room to grow, but clearly their real estate bubble was potentially the greatest bubble in history. And that is not going to be an easy thing to dig out of. There is a case to be made for the Japanification, the 1990s spell of China, where people have saved in the form of real estate, and that's not going to work for them going forward. But the rest of the emerging market map is just approaching a point now of sort of GDP per capita growth where the intensivity of use of basic commodities really takes off in terms of a volume growth story. And I think that that's underappreciated because it's nonlinear. There are sort of points in general where these populations cross on a per capita basis, where their intensivity of use flips non-linearly and grows sort of exponentially for a while, like almost like the S curve for tech, sort of models and in thinking about their growth. It's not growth to the sky, but we're approaching a window for India is not very far away. Indonesia is not very far away behind them. My buddy Louis Vincent Gav from GavCal, he likes to draw this line from Istanbul to Jakarta with 1.5 billion people within a few hundred miles of either side. And he says, you think about that 1.5 billion people, that's greater population than all of China today. And they are where the Chinese were in the late 90s, early 2000s. And their per capita growth is approaching a tipping point where past investments of going back a decade in commodities are wholly unprepared and part of the function of sending the clearing price for commodities at the margin higher, and that the supply side response to that emerging demand statement is just not there and won't be there for a while. And that argues also for this potentially being a terrific point of transition away from the tech and consumer and the Western story of leadership especially in the equity space, where valuations have rarely been higher, to the relative undervaluation of the proverbial things that fall on your foot will hurt. that spread has blown out to proportions we rarely see over time. And it's not to suggest that it will go the other way immediately, but it's a point of opportunity for reallocating capital towards projects that we are going to need. And without it, we're looking at price being the arbiter of rationing demand and potentially slowing the growth in some of these economies, absent heavy investments. So it ties into sort of a bigger picture framework I have where different economies are. This isn't a China behemoth, turning on the light like 2002. These economies are moving at different speeds at different moments in time. And the commodities are sort of reflecting something similar where they're running into their own supply constraints at different moments in time. You have substitution effects of rolling from one to the other. A classic example I can give you is that just as copper has now come off the boil, the narrative around Chinese substitution with aluminum is getting very loud, and that aluminum is next. I would caution people, aluminum has quite a bit of spare in China, and it's been raining like hell in China. Their reservoirs are fully topped up. So they can, you see a higher aluminum price here in substituting for copper. The smelters are going to hit it, and they're gonna run, and they can, right? Their issue right now is not a higher electricity price and a low aluminum price results in shutdowns at the margin. They can now go the other way. So I hesitate to buy aluminum with both hands on a rotational trade per se, but I just find it interesting that new highs beget these kind of narratives from the natural buyer of these commodities as well. And that we live in a truly rotational world where you kind of need to be paranoid in the sense that you're watching everything all the time, because these relationships sort of ping pong around between both economies in different countries and different commodities and across asset classes.
Yeah, I'm really glad you mentioned Southeast Asia and the amount of growth that's happening there, and obviously population. Just that's massive amount of people within the global ecosystem. And I always, whenever I think about, that rising demand, I always come back and kind of speculate on what may have been with President Obama's Trans-Pacific Partnership that didn't come into fruition, got a lot of pushback. But on the cover of that thing, and despite what anybody thinks about Obama's legacy as president, in hindsight, it kind of feels like that partnership really would have been a great setup for the United States import-export business, and specifically with raw materials and resources. Have you given that any thought at all, since your time when you were working and following the commodity space, and what that potentially might have led to?
Specifically, sorry, Trevor, I missed the first part of your question.
Oh, sorry. So I was talking, what the Trans-Pacific Partnership under President Obama, with the amount of growth and demand, what that really potentially could have led to, with the United States being, a particular force in relationship with trade in South and Southeast Asia, on the back of resources and commodities. I don't know if there's a linkage there. Just on the cover of this that whole thing, it almost sounds like it would have been an incredible setup for decades to come for the U.S. to have more partners for resources outside of China, despite what you might think about, Obama's legacy.
Yeah. Well, parallel universes, right? We live in this one. So, and that was a long time ago. I guess I would say, the world has started moving in a very different direction from what we grew accustomed to beginning in the 80s and through the Obama administration. I mean, Trump sort of, his purpose, as it were, was to play a chicken game of heads up rather than a cooperation game. And, left or right, you look at Obama, Bush, Clinton, Bush, Reagan, the whole idea was always a cooperation game with allies through the projection of strength and also through pairing off. This is my own opinion. I'm not a geopolitical guy by any means. I watch these risks, but I'm nowhere near as informed as the experts in the space, as it were. But regardless of political leaning, the U.S. soft power approach always seemed to be to pair off or face off two regional powers against each other, so that they're busy sort of playing tension points against each other. In case of Middle East, it was Saudi Iran or Iraq Iran after Saddam Hussein, and in the Far East, India, China. Even if you look at, say, the I guess it really comes down to that, right? The idea of a cooperation game being played ended with the Trump administration, and we can't put that Humpty Dumpty back together again. So the notion of America first, and I have no personal feelings about this one way or the other. This just is, in my opinion, where the world's gone, plays into sort of an increasingly isolationist under the Trump administration approach to the United States, similar to something that we had between World War I and II in reading history. The Biden administration has had sort of a seemingly more kind of sclerotic sense of geopolitical priorities, but I think all of these, the tumult of the last 8 years in the U.S. approach to foreign policy has resulted in an environment where multipolarity is now becoming a thing. The poles of power around the world are increasingly fracturing, and that we're moving to a place where perhaps, and this goes to the heart of the arguments around de-dollarization and the reserve currency and whether or not that's still going to be a thing in 10 or 20 years. And that's sort of the ring that rules them all when we talk about commodities and different assets and risk. This is how you sort of start walking down that road where you don't have a single sole superpower or, offsetting superpowers the way we had during the Cold War, followed by kind of 30 years of, Pax Americana. Now we're into something else. And it's a world where I tend to think that volatility is still mispriced. Commodities reflect a form of that volatility. And to your question about Obama and the TPP, I think these sorts of agreements are ancient history. It's almost kind of like a barroom brawl in a geopolitical sense, where guys just have their own corner of the room and occasionally they come out swinging, and nobody really, like any dispassionate observer, doesn't really seem to understand what's going on, because alliances will shift, and the driver of those underlying alliances are the political expediency of getting elected next or maintaining power if it's an autocratic system. And that countries, generally speaking, are more concerned with managing their domestic priorities and inner turmoil than looking out. And I think that also explains a lot of why we're seeing the sort of sclerotic, non-committal, just the tip responses to Russia, Ukraine. And yeah, it's, just head on a swivel in terms of geopolitical risk. I tend to think that geopolitical risk is among the more mispriced risks out there for risk assets in general. And I don't say that as like a zero hedge hide, in your basement kind of guy. I just, I think that these sorts, it's sort of like the world goes through war cycles the way we also go through default cycles. And as someone who spent a lot of time focused on EM, I can tell you that waiting for defaults in emerging markets is sort of like waiting for the New York City bus. It feels like you're standing there on the corner for, ever, and then suddenly 3 or 4 of them show up all at the same time. And the first 3 are all packed. And, geopolitical risks to me are kind of doing something similar. We're standing on the corner. We've seen a few, like small buses go by, but nobody seems to care or react. And now, like maybe in the next few years, a whole bunch of buses are going to show up all at once. It's just the nature of these cycles because human history doesn't change, right? And
yeah. Are you seeing something like that kind of start building in Latin America? And there's been a lot of speculations following the Mexican elections and Shenbom coming in, and what that might mean for Mexican mining sector. And on the other end of the spectrum, we have Milei in Argentina. It seems like Brazil seems to be in a pretty decent spot. There's a lot of activity down there in regard to resources. Guyana is obviously pushing their resource sector ahead, as best they can and pursue growth in their economy. Peru's done a flip flop from not a great place to explore and mine to that's back on the go-to list now. A lot of projects coming back onto the market. I mean, it's all over the place in Latin America right now. How do you best kind of constructively have those conversations with people interested in resource development in the area?
Great question. And actually, if you think about it, LATAM is sort of a microcosm for what we were just discussing about the breakdown of, into multipolarity. People used to allocate to LATAM or not, right? As part of an overall EM allocation or not. But every EM is sort of in a different spot now. And you really have to drill down country by country to see that policies are moving dramatically in different directions. We had a huge pink tide in the 2000s in reference to just the rise of the left. And then we had the backlash where the needle swung to the right, most visibly with Bolsonaro in Brazil. But now you also had Macri in Argentina for a spell, and then they slid right back into Kirchner in Argentina, for example. And now we're swinging wildly back the other way. It's almost like a metronome on the piano, right? Swinging wildly back the other way to Milei. And this scleroticism in domestic politics is to the heart of what we were just saying, that in Mexico, ironically enough, the outgoing president demonstrated probably the world's most stringent and fiscally tight approach to COVID, at least that you could speak to in the Western Hemisphere. While the US and Brazil were blowing a ton of percent of GDP on public expenditure, Mexico actually ran a very tight ship. So you have a proverbial populist who claims to be a man for the little people, who is actually doing a stark impression of a fiscally conservative leader. This window now of transition, I don't know, I don't presume to know where it goes. I don't think anybody really knows, but it's worrisome because we've seen this sort of, when you start to mess with the courts, you're really screwing with or even potentially mentioning messing with courts. That's where investors, especially foreign money, starts to take a very deep breath, because rule of law is everything. And this actually ties back to a project that I did for myself, for my own money. Back in May of 2021, copper had a huge run for the prior year out of the COVID depths. And I realized I'd been removed from the copper sector for over 10 years. And I actually had no idea what properties were in what stage of life cycle. And so I spent my Memorial Day weekend of 21, just locked in my bedroom for 2.5 days. I told the wife, listen, I'm sorry, I need to do this for me. And I put up a map on the wall and started going through presentations of all the copper junior producers and explorers that I could find with any kind of project of consequence, anybody with a resource, along with the bigs, and sort of just trying to remap where key assets were and what had been developed over the prior 10 years, what was moving along, et cetera. And trying to come up with a short list, and then knowing that the reason why I was doing that project probably meant it was some kind of top in copper. And this was when Jeff Curry at Goldman was out there saying supercycle 2.0, that I was probably late to the game. And so I did the project, but then I told myself I'm taking a mandatory 1-year time out from this. And it was auspicious because then Chinese real estate really started to fall down the stairs in late summer, early fall of 21. And so that kind of gave me a good 6 to 9 months of just watching to see what the impact on copper demand would be from the bubble bursting in Chinese real estate. Obviously, it wasn't pretty, but if you had told me that China was about to fall apart, lockdowns, weak reopening, et cetera, I would have told you copper $2. And the fact that we bottomed in the low threes and then we're sort of sticky in the high threes for the last 18 months while it went to sleep and people stopped caring. I got admittedly involved too early in like April, May of 22 and sort of bought on the way down and have been kind of sitting there with a core position in junior miners. This is a long kind of setup to explain most of the time in this super cycle, I want to be as close to the physical as possible because unlike in the 2000s where the miners and the FERTs, if you're talking ags, or the juniors and the producers, if you're talking oil and gas, are giving you the beta and the torque. This time around, because of the nature of the supply constraint, the nature of multipolar world, of jurisdictional risk, which I'll talk about in a moment, it just means that managements are going to have an increasingly hard time developing projects, permitting now taking 15 plus years from whole to production in some of these long life projects. I mean, it's an eternity. It's basically telling you this stuff is never going to happen. And the market will have the answer to this eventually. But I just worry that there are so many ways to get skinned in the equities that like my default is I start with the commodity and I only fray into equity expression if there's something really special going on or where there's a very clear divergence or crack up in the space for whatever reason, usually unrelated to what's going on in a handful of equities that I'm watching closely that get me in there. In copper, it's a little different because unlike, and uranium is a classic example, uranium equities were pricing, the juniors and non-producers were pricing 70, 75 a pound 2 years ago when the price of spot was in the upper 40s, right? Clearly they had run ahead. So I had little interest in being in the mining equities until uranium really started to move. And despite their overvaluation, I saw this kind of trade we discussed earlier. And it felt like I don't want to be in the miners per se, but I can see why flow of funds would help torque this trade and both converge to the top side around 90 or 100. Here in copper, the juniors got to a point where they're so underfunded. And certainly there's a lot of crap in here, to be clear. And none of this is advice, mind you. But it occurred to me that we are entering sort of the second phase of the bull market where the majors have been so committed to capital returns because all of the CEOs' predecessors got fired over the last 10 years for all the sins, like buying nickel, if you're an iron ore company, that they made during the last bull market. And the guys who are in charge today remember that. It's not 30 years ago. This is an institutional memory at the top where they're being very careful. And this is why you saw BHP, underbid for Anglo and remain very tight about the price that they were going to pay and not offer a ton of equity and, make it as complicated as possible so that they really couldn't lose. But of course, you're not going to get Anglo shareholders to agree to that. So wrong moment in the cycle, right? But if these sorts of larger transactions aren't going to happen, because that's what happens in the meat of the move, like in the 2006 moment that we talked about, where Phelps Dodge, Falconbridge, Inco all go, to get there first, these guys still have a need. And that pressure is going to come from shareholders who watch the commodity price go up and realize that the equities aren't giving them any beta to it. They're keeping up 1-to-1 or maybe even lagging the move. And then they start calling up the CEO and saying, yeah, we know that, we told you capital returns are paramount over the last 5 years, but now where's the growth, right? Like I own your stock because I want leverage to commodity prices and you're underperforming the commodity price. So why don't I just go out and buy the commodity? Guys lose their job for that too. It takes time, but they're starting to get these comments from shareholders. And the next step for them is like, it's a little colorful, but I call it like just the tip, like from Wedding Crashers, where if you can't take down Anglo for a really stupid price because they'll say no, maybe you can take down an advanced exploration play or a junior producer with 10 to 15 years in front of it still that you know pretty well for an amount that won't get you hurt if you make a mistake. So you pay $1 billion or $1.2 billion for a project that allows you to bolt on some extra, proven improbable or, a resource onto your declining portfolio. That you want to mitigate career risk if you sit in the C-suite, right? And that's probably the way you do it if you can't buy something that's truly sizable on the cheap, is you pay a mid-cycle price for something that's small. And I tend to think that we're on the cusp of another wave of M&A in the base metal space, in copper specifically, where projects that have updated resources, that aren't too aggressive on cost, with alignment with key shareholders and management, skin in the game, you're going to start seeing headlines of either direct stakes taken, either in the equity funded by bigs, and we've seen some of this already in the last 2 years, or even JVs funded by the Ontario Teachers of the world, where they inject capital direct at the asset level and they'll buy 10% of a mine at the mine level in order to help fund the round into the BFS or even like help dress the company up for a sale and finish a drilling program, what have you. We're going to see the volume of these deals go up. It's an inevitability almost in my mind because of what the price has done. And because I don't expect the price to go back to $3. I don't expect the world to tip into the next Great Depression. And for all those reasons, I think that there is work still to be done in the copper junior sector with an eye towards M&A. And coming full circle back to your question at the top, sorry for the very long-winded circuitous answer, is when I finished this project in 21, I ranked a series of junior mining, advanced exploration, and junior producer names in the copper space. I tried to be as comprehensive as possible, but there are plenty of names I didn't get to, where I ranked them on a series of just factors. And the first three were jurisdiction, jurisdiction, jurisdiction. Only after that did I look at alignment and credibility of the management team and their experience, and their pockets, their backers. I tend to follow we used to call Ross Beatty the broken slot machine back in the 2000s. The guys who have this kind of model of constant spin-offs and focus on individual assets that they view as most promising, and sort of spawning a mothership with smaller fast boats that they can market at different moments in time and unlock value through the drill rig without being pikers and actually having a reputation for doing this successfully. And there are a handful of players like this in the game today. Lundin probably gets the most attention, but some of these guys are still out there. And I think it's actually a testament to the fact that they've survived over the last 10 years, that you want to be watching where they're positioned, because that most likely the wind is going to be at their backs versus others, and that their ability to access capital markets here in the next few months and quarters will play to their ability to unlock value in an eventual sale to a major or developing the project themselves. That's kind of how I tend to think about the copper space. And you want to be highly selective, obviously, but for me, jurisdiction is the first three things. I actually tend to think that Argentina has become very interesting. I know it's easy to say that now that Malay actually won, but I was thinking this a year ago because there are things, particularly with San Juan province, that give me great comfort around, like, when I think jurisdiction risk, I tend to, and this is very colorful, but like when you're surrounded by men with guns to assure the success of your capital investment, you're probably doing it wrong. And to your point about Mexico, the biggest issue I have with any country screwing with their constitution isn't who's necessarily in charge. It's what they do with rule of law in the courts. And the moment you start to call that angle of a landscape into question, you're already losing the battle. And you end up in a place where militia are either on your side or not, and you live or die, free cash flow wise on their good graces. Like, I can't be there. And there's just an existential risk to that I don't know how to underwrite or price. Interestingly enough, about Argentina, even pre-Malay, is that while the country has clearly gotten much poorer over the last 10 years because of their financial and institutional crises, you've never seen the level of violence and uncertainty around property, absent obviously the Repsol YPF issue many years ago. So these guys know how to nationalize and create a fracas, but there's certain provinces that seem to recognize which side of their bread is buttered in terms of where the money comes from. San Juan seems to be one of them, and the majors seem to recognize that through their drilling activity having picked up over the last few years before Malay. And so maybe I'm deluding myself a little bit, but I worry more when I hear Friedland talking about doubling down on the Congo because it's at surface and the ground is green and it's to 6%. Like, all that's great, but a flare up of violence anywhere in the region gives me great pause. He's done a terrific job of building assets in that part of the world and managing these sorts of existential risks, but they are existential in this. And maybe I'm talking out of my head and I'm not close enough to the situation, but they feel existential to me. Whereas I don't see a lot of armies with guns rolling around the Andes. I know that if things get salad for that part of the world, they'll tax you more. But Mexico, when they start to mess with the courts, introduces a level of jurisdictional risk that I don't necessarily have a visibility on where this ends. And I haven't felt real stress from the business community yet, to the point where people are like bleeding in the streets. And I say, okay, like, this asset is priced for a true screw up institutionally. And I can underwrite that because it's so cheap. You know what I mean? So you have one part of LATAM that seems to be moving in one direction over the next few years, and where the public actually seems to be embracing, like, we need to do something new, and that tends to be pro-business, like Argentina, and Mexico is going the other way, and the big shops are taking notice of that. I tend to think actually that San Juan could end up being one of the great next jurisdictions, assuming again that I don't get blindsided by something in the local national level, where, it looks like the Congo did, 15 years ago, and the money comes in and certain projects get built, and then inevitably taxes will go up and there'll be headlines and some leftist will come in. But, there's a window here for the next few years where things are getting worse, but they're not getting worse as quickly. And in some cases, they're actually even getting better. The delta is moving in your favor. I don't know if that answered your question going back way back.
There's
to
a
how
lot of
this
food
started.
for thought there. There's a lot of food for thought.
Yeah, jurisdiction. Like, we didn't have to worry about jurisdiction in the 2000s. I think history has shown us in the last couple of years that jurisdiction should be the first thing that comes to mind before you start even doing any work on the asset or the management team, in my opinion.
Yeah. Paolo, I've taken up most of your time for the hour, and so we'll probably going to have to leave it at that, although I'm pretty sure we'll have you on again here as we progress throughout 2024. I really appreciate your insight. I appreciate the time you not only gave me in the concrete jungle of New York a couple of weeks ago, but also the time you give us here this morning. I would recommend go check out Paulo Macro's Substack. He also does a podcast with a good friend of ours, Les Shrub. It's always fun. It sounds like the two just recording each other as they walk into the pub for a happy hour cocktail. It's usually a pretty good time. You kind of feel like you're there just kind of chiming in. But yeah, thanks so much, my friend. I really appreciate this. Yeah,
sorry to kind of ramble and run long. It tends to happen. But and I hate doing this at the end during the goodbye. I should have said it at the top. Like, nothing we discussed is any kind of investment advice. It's only how I think about the world. I don't want to mislead people into, buying or selling something, do your own homework, yada, yada, all of that good stuff. This is really just me thinking out loud about the space and thinking back on some trades and how I kind of express my own money, and it ends there, But
absolutely.
Trevor, it's been really great. Thanks for letting me kind of think out loud here for the last hour.
Thank you so much, and thank you for sharing your thoughts.
Yeah, have a good some good time off.